Welcome to First Responder Financial Freedom Podcast. We talk to first responders all over the nation who are investing and working on businesses outside of their first responder jobs. Our goal is to motivate and educate each other and help provide a better financial understanding for a better future. Now here are your hosts, Mike Webb, Tyler Thrush, and Aaron Foster.
What's up, everybody? This is Tyler with First Responder Financial Freedom, and I am coming to you solo tonight. When we started this podcast, we had agreed that we were not going to miss a week for the first 52 weeks, and that is why you only have me. Unfortunately, we are only able to secure one guest, yours truly. We don't have any guests scheduled for this week, and Aaron and Mike are both busy, so I'm going to do a real quick short podcast. Just kind of go over state of the mortgage market, since that's where I find myself the most busy these days, and then kind of discuss what I'm doing investing, some updates for Aaron and Mike, and that's about it. It's going to be a short episode, but on that note, please know that we are looking for guests. So if you know of any first responders who currently own a business or have a specialty that they invest in, please reach out to us and let us know. Send them the link that can be found in multiple posts in the First Responder Financial Freedom group. Or you can just have them reach out to me directly at Tyler Andrew on Facebook. So with that being said, let's get started. So as far as the mortgage market goes, the last 2 weeks, rates have gone down over the last 2 weeks. Pretty big jump, about 0.6%, 0.75% in some cases. And what I'm seeing because of that is you're having a lot of buyers who were previously on the sidelines start to jump in and begin to get pre-approved, pre-qualified, and starting to submit offers. So I haven't seen anything concrete, or the pre-approvals that I've been doing for those borrowers have resulted in contracts. But my pre-approvals have definitely increased over the last 2 weeks, which is good news. It tells me a couple things. It tells me that there's still a demand for houses, but interest rates are kind of holding that demand up right now. And secondly, with 2 consecutive weeks of rates being low, gives us hope for the rate hikes to stop climbing, or maybe climb a little bit slower. As everybody knows, the rates, started taking off earlier this year, and they have just continued to progress at a very rapid pace. Overall, historically, I know there's a bunch of stuff out there right now where people are discussing the fact that, rates in the 70s and 80s were so much higher, and that is true. And my first year in the business, I was still doing loans at 6.75, 7.75%. And those were VA loans, which, VA loans, even right now, are usually going to be a little bit lower than conventional rates. So I was able to function in that market as a mortgage broker, and then also as a real estate investor. I got started in the early 2000s. I've been in real estate for a little bit over 21 years now, as far as an investor or agent or a broker goes. And I was right in the thick of it through 2007, 8, 9, and 10. And it was rough, but what it taught me was deals are still going to be done. It just, your underwriting has to change, whether it's me as a broker or me as the investor. Underwriting changes. You have to underwrite deals based off of where we're currently at and take the declining market in mind. But there's still plenty of deals out there. And what I'm seeing on the investment side out in Boise is we're having a lot of price reductions, but there's still that disconnect between what sellers think their house is worth and what they're actually worth at this current moment. So does that mean that I'm going to stop investing in Boise? No, absolutely not. It means that I'm going to wait until those seller expectations have been tempered, whether it's through multiple discussions with my own company, whether they are reading the news, hearing the news. That's the one good thing the news is good for right now, is there's no shortage of news channels stating that, the real estate market is drastically cooled off, and are we going to have this crazy crash? And that's starting to get the seller expectations in line, but we're still not there yet. So once that happens, I think it's going to be prime time for buying. And so on that note, I'm not slowing down my marketing. I'm not stopping my marketing. We're marketing as usual, and we're underwriting deals a little bit more conservatively than we were the last 2 years. The last 2 years, we could write stuff up to 80% of the value, less repairs, and we knew that we had multiple buyers waiting at the end of the transaction, and we would be good to go. And one of our best methods at that time was even selling to Opendoor for a little bit, and that was extremely lucrative. Now you have a lot of the iBuyers pulling out. You have a lot of your end buyers, if you're a wholesaler, pulling out. Or backing off those aggressive models at the 80%. Most people that I talk to are anywhere from 60 to 65% of the after repair value, less any repairs. And that's where they're coming in as far as their offer price goes. So it's a big difference, but it's a necessary difference. And those who stick to their numbers right now and underwrite at the current deals or at the current prices are going to do very well, I believe. So I'm excited. I'm waiting for those expectations to get met. And once they do, it's going to be prime buying season. So in the meantime, when I'm looking for those deals and I'm waiting for those deals, what I'm focusing on now and have been focusing on for the last few years is private lending. And essentially, I am acting as the bank for wholesalers and flippers that need money. Now, as far as that goes for me, what I'm targeting for a return is the reason I like it so much is I'm trying to get 2 points. So a point is 1% of the loan amount. So if we have for every $100,000, let's say, 1 point would be $1,000. So I'm asking for 2 points, or in that same example, you would be at $2,000 plus 12% interest. So 14% interest is what I'm getting if I use the money once a year. What I'm trying to do is underwrite these things and write the mortgage note at a 6-month term, meaning I will lend the borrower that money for 6 months. And then in turn, they pay me 2% up front. And then they pay me monthly payments based off of that annualized interest of 12%. But if I can do it twice a year, the points I get to charge twice because the mortgage has been originated twice in 1 year. I'm now at 16%. And for me, 16% that is secured by real estate is phenomenal. I will take it all day long. And as long as the deals are good, then I'm willing to do it. And on the same token as Boise, that means now when I'm underwriting deals that I'm lending on, I'm also going to be more conservative. So whereas last year I may have pushed the after repaired value, I want to see things, at 50 or 60%. That's going to be my max loan amount as far as the ARV goes. So for $100,000, the most I'm willing to lend on that in a first position lien, which means I get paid first before anybody, would be $50,000 to $60,000. That, in my opinion, is a very safe investment. I would much rather be doing that right now than the stock market, but that's also what is in my comfort zone. So I've always stuck with real estate. I'm not super big into stocks. Obviously, like most of you that are in, safety, I have a 457. I contribute up to my match, and then after that, all the additional money goes into my investing. Or I go and I have a solo 401k, which is basically a 401k for entrepreneurs. And I can invest a certain dollar amount of my profits, or actually any of my revenue, into those accounts. So the cool part about that is for a 457, I'm not sure what this year is, as I don't keep track of it, to be honest with you, because I don't invest as much. Like I said, I'm more focused on my match, but I think the last few years it was like 17,500, for example. The crazy part is for the solo 401k, this year you were allowed to go up to $57,000, I believe, which is a massive difference. And the beautiful part about that $57,000, unlike my 457, is the $50,000 can be self-directed. So now I can also do private lending with my own cash, but I can now use my retirement funds from that solo 401k, and I can get 16% on that money that is tax free, and I can continue to do so on that account. So I am big into private lending right now. I'm trying to increase my solo 401k as much as I can each year, which will in turn give me more and more capital to invest with the private lending. And I think that's going to be it's going to be a huge boost for me at the end whenever I decide to retire. That's going to be a lot of money that I obviously wasn't originally counting on when I got hired for the fire department, but it will be a good boost for my income as well. And then lastly, we are still focusing on our rentals. Again, I'm not going to stray from my numbers and as far as what I want for a rental. When I was buying properties in 2007, 8, and 10 during the last downturn, I got a little loose with my numbers. I didn't end up losing a house or anything like that. Luckily, I had partners on our rentals, and we just ended up having to hold them through the downturn and wait until we could actually sell them and not lose money. But it was a lesson well learned. We ended up doing decent on a couple of them. I believe we broke even or maybe had to pay a little bit at closing for another. But overall, we didn't do too bad. We just had to hold on to them longer than we had anticipated, which taught me a few things. It taught me, A, don't stray from your numbers. Know your numbers. Know what your returns need to be. And if the property does not fit those numbers, then it's not your deal. You either need to renegotiate it to where those numbers do work for you, or you need to go find some more deals. And the reality is, especially now as we are headed into a recession, continuing a recession, depending on who you believe or what you listen to, but there's going to be more and more deals. So patience right now, I think, is a good virtue as far as that goes. As far as don't compromise your deal standards right now because you're itching to get some deals. And I have talked to a few people in the last week from the group, and they're itching to get into investing, which is awesome. And that's why we're doing this, is to expand people's horizons and get them involved in something that I know Mike, myself, and Aaron all believe is a great asset that's backed by, a great investment that's backed by real estate. And we always say, we're going to do the fire ready aim, but in this instance right now, it would make sense to not compromise deal standards because you don't have the benefit of an appreciating market. Stick to your numbers and wait for those deals to come, and they will come. And when you get one, that's a good indicator that people are more willing to negotiate based on today's pricing, and more will follow. The worst thing you can do is act like each deal that you're underwriting is going to be the only one that comes around. It's a scarcity mindset, and it's just not true. Keep underwriting deals, don't compromise your standards, and those deals will come. So that's the big thing for me right now, is mortgage rates are headed down, which is obviously a plus for many reasons. A, for my mortgage business. B, it's going to increase activity in the real estate market, which should help all of our investments. B, I'm getting more and more involved in private money lending. I love it. It's secured by real estate, which is something I know very well. The returns are phenomenal, and I'm going to continue to do it, whether it's my own cash or, like I mentioned, it's money for my 401k. And then the last thing is I'm still going to be buying rentals. I'm going to keep buying rentals because that's another avenue for passive income or semi-passive income, depending on who you talk to. And I'm going to keep doing it. But like I learned from the last time, I'm not going to compromise my standards, and I know those deals will come. So that's pretty much all I have going on right now. Aaron and I are actually very close to pulling the trigger on an investment together that was brought to us by somebody in the group. As soon as we do that and we have it solidified, we'll be sure to let you guys know in one of the upcoming podcasts as far as what the deal was, how we underwrote it, what our expectations are for the investment, and then most specifically what I want to focus on is worst case scenario. What is the worst case scenario as far as what's going to happen if this investment doesn't work out? Which is important, is know where the best case is, know where the worst case is. And if you're good with both of those, then that's usually my indicator to pull the trigger. So hopefully this was helpful. I know it's a very short episode, but our goal was to get this out so we don't miss any weeks and just kind of give you guys a quick update. We'll probably do these every once in a while. Maybe it'll be myself or Aaron by himself or Mike, but just kind of give you guys a little bit more insight into our own individual businesses. So you guys have a little bit different perspective each week. Let us know if you guys like this episode. You're not going to hurt my feelings if you don't. And we will catch up to you guys on the next episode.
Thanks again for spending some time with us today. If you found value in anything you heard, please share with someone who may benefit. We look forward to connecting between shows in our Facebook group, First Responder Financial Freedom. Till next time.